The scariest thing about debt is not how much you owe, but how quietly it starts owning your choices. You don't see that yet. At 6:47 in the morning, you open your inbox and see the number sitting there like it has been waiting for you, $47,200. Student loans, one credit card from freshman year, a laptop you swore was an investment in your future. You are 23, sitting in a cubicle on the 14th floor of a building you could never afford to buy, telling yourself this is normal, this is temporary. This is just where adults begin. You pay the minimum on 3 different accounts and feel responsible for doing it. You do not ask what the minimum is designed to do. You do not ask why the balance barely moves. You just watch the interest appear like a ghost charge for being alive one more month. The number grows while you sleep, while you eat, while you ride the elevator, while you pretend you are getting ahead. You are paying money for the right to keep owing money, and somehow the world has taught you to call that progress. Then the credit card company sends you a limit increase, and for one strange second, it feels like approval, not from a person, not from someone who knows your name, your stress, or the way you refresh your account before payday. Just an algorithm deciding you are useful enough to lend more to, but you don't know the difference yet. Approval feels like approval when you are young and tired. You start thinking of debt like weather, annoying, unavoidable, something you survive instead of question. You don't ask who owns your debt, because you don't even know that is a real question. You move through it by habit, the same way you move through traffic without understanding who designed the roads. You think you are in debt, but really you are inside a machine. The company you work for borrowed money to buy the building you sit in. The bank holding your tiny savings account is leveraged against its own equity. Even the dollars in your wallet are promises built on promises, and you are spending them on lunch. That night, you check the balance again. $47,312. It was $47,200 this morning. You did not buy anything. You did not make a mistake. You did nothing at all, and still the number moved against you. For the first time, something cold passes through your chest. Not panic, exactly. More like recognition. You are starting to understand that debt does not need to yell. It does not need to chase you. It can sit quietly in the background and grow while you are busy trying to become someone. By 28, you look successful from the sidewalk. You have a house now, a mortgage, a car in the driveway, and a job that sounds stable when you explain it at dinner. The mortgage is $340 million at 8%. You did the math before signing. You knew you would end up paying far more than the price of the house. You understood the numbers. You signed anyway, because everyone told you renting was throwing money away, and ownership was the next level. You believed them because you wanted the picture to be true. The house feels like a win at first. You paint one room. You buy better furniture. You stand in the kitchen at night and tell yourself you made it. But then the first month stacks itself in front of you: mortgage, car note, insurance, repairs, utility, credit card, student loan, home equity line. Your take-home pay looks good on paper, but somehow your freedom feels smaller. You start noticing that before you decide anything. The payments have already decided most of it for you. You stay in a job you would have left. That is the first sign. Your manager talks down to you in a meeting, and you smile because the mortgage is due on the 1st. You see a business idea online and close the tab because the car payment hits next week. A friend moves cities. Another starts over. Another takes a risk you secretly wanted to take. You run your numbers late at night looking for permission. The answer keeps coming back the same way every time: not yet. The home equity line resets higher. The Federal Reserve raises rates again. You read the headline on your phone like it belongs to someone else. Then the statement arrives and proves it belongs to you. Your variable debt gets more expensive without asking how your month went. Nothing dramatic happens. No villain kicks down the door. The house still looks nice. The car still starts. Your neighbors still think you are doing well. That is what makes it dangerous. From the outside, debt can look exactly like success. Underneath the picture, there is a structure. $387 million in liability waiting every month before you even sit down to think. Between what you earn and what you keep, there is a gap, and the debt lives inside that gap like it signed the lease before you did. You are not broke. You are not failing. You are just less free than you appear. And the most frightening part is how easily you adjust to it. How quickly a cage becomes normal when everyone calls it adulthood. Then you decide you do not want a cage with better furniture. You want control. You want your own business, your own name on the door, your own decisions. So you borrow $280 million from an SBA lender at prime plus 2%. You sign the papers with a hand that barely shakes. You open a 200 square foot commercial space, hire 2 part-time employees, and deposit $14 million into the business account. For one beautiful week, it feels like escape. Then the first payment comes due. The loan has a personal guarantee. You understood that phrase when you signed it, but you did not feel it until later. If the business fails, the debt does not stay in the business. It follows you home. It walks past the front desk, past the logo, past the dream, and sits down at your kitchen table. Personal debt changed what risks you could take. Business debt changes what every hour is worth. You no longer wake up asking what you want to build. You wake up asking what today will cost. Every day has a meter running. Rent, payroll, utilities, software insurance, interest. The lights cost money before a single customer walks in. Your employees clock in with normal faces because they do not know what you calculated at 2:14 a.m. You smile and ask how their weekend was, while part of your mind is counting receivables, payables, and the exact number of days until your account balance gets ugly. You wanted freedom, but freedom now has invoices. A client owes you $22 million. They are slow to pay. They sound friendly on the phone. They say accounting is processing it. They say it should clear soon. Your bank calls that receivables exposure. You call it the reason your chest feels tight for the fourth month in a row. On paper, the business looks alive, maybe even promising, but paper does not make payroll. Paper does not pay rent. Paper does not stop your hands from checking the account before you brush your teeth. This is where you learn the cruelest business lesson in a way no textbook can teach. Profit and cash flow are not the same thing. A business can be profitable and still run out of money. You used to think that sentence was financial advice. Now it feels like a threat. You pull a $30 million salary, less than you made at your last job. But when people ask how things are going, you smile and say, "Good. I work for myself now." You do not mention who actually owns your time. Payables are due Friday. Receivables clear Monday. 3 days become an entire battlefield. You have crossed this bridge before, too many times. Your 2 employees do not know they are standing on it with you. They make jokes near the printer. They talk about weekend plans. You nod and laugh because leadership sometimes means hiding the panic well enough that no one else inherits it. The bank schedules an account review, and you know exactly what kind of call this is. You prepare the night before like you are defending a life you built with borrowed breath. You open spreadsheets, clean up projections, rehearse answers, and refresh the balance even though you know it has not changed. The lender does not care whether you had a good month or a bad one. The loan is due regardless. You do not regret starting the business. That is the complicated part. You are proud. You are terrified. And for the first time, you understand that debt can turn ambition into pressure. Years later, you are no longer the small business owner pacing in the dark. You are VP of Finance at a mid-market company doing $480 million a year in revenue. You manage $120 million in revolving credit facilities across 3 banks. You know the covenants better than you know your own lease. Net debt to EBITDA cannot cross 3, 5 times. Interest coverage cannot fall below 2, 8 times. These are not just ratios. They are tripwires. Every quarter, you measure how close the company is to the edge. If a covenant breaks, lenders can accelerate the debt. That means the money becomes due faster than the company can breathe. Liquidity crisis. Emergency board calls. Frozen decisions. People who thought they had normal jobs suddenly waiting to see if payroll stays normal. You keep a folder on your desktop for that scenario. You update it every 90 days, quietly. Because panic is most dangerous when it arrives unprepared. You have already restructured the company's balance sheet twice in 4 years. Both times, the official language was clean. Improved capital structure, extended maturity profile, optimized liquidity. But you know what really happened. You bought time. You refinanced short-term pressure into longer-dated pain. The interest cost more, but the runway saved the company. You negotiated through sleepless weekends so other people could come to work Monday and never know how close they came. At this level, debt stops feeling like a personal mistake and starts looking like infrastructure. You do not think of it as something owed. You think of it as something deployed. Every board meeting, you present leverage ratios, covenant headroom, and facility utilization with a calm voice and clean slides. They see the numbers. They do not see the folder on your desktop, the weekend calls, or the way your stomach tightens when EBITDA comes in soft. You remember when $47,200 felt impossible. Now you manage $120 million before breakfast. Somewhere along the way, the language changes and you change with it. Debt becomes capital. Risk becomes exposure. Loss becomes impairment. Fear becomes scenario planning. You are not lying when you say these words. They are accurate. They are useful. They keep everyone in the room from sounding emotional. But sometimes, while walking back to your office after a board meeting, you realize the vocabulary has not only described reality, it has softened it, cleaned it, and made it easier to carry. Then the room gets bigger, much bigger. You are a managing director at a mid-market private equity firm. and you have just closed a $2, $1 billion leveraged buyout. The wire clears at 11:43 a.m. The structure is elegant, $630 million in equity, $1. $47 billion in debt layered across 3 tranches. The debt sits on the acquired company's balance sheet, not yours. That is not a detail. That is the mechanism. The company now carries the weight of its own purchase. You understand leverage at a level most people will never touch. 7 platform companies in 6 years. 3 are performing. 2 are being restructured. 1 sold at a 4. 2 times return. 1 you do not talk about. You know exactly how much debt a business can carry before it starts bending. Then you push it close to that line deliberately. You call it capital efficiency. Your limited partners call it discipline. The management teams inside those companies have other words for it. The pressure inside those companies is real, even when it has no name in your memo. Payroll gets tightened. Departments get combined. Projects get paused. People who gave 10 years to a place are told the organization is becoming leaner, stronger, more focused. You have laid off 340 people across 2 portfolio companies in 18 months. You know the number exactly. You felt something the first time, less the second time. Eventually, you stop measuring what you no longer want to feel. The math is beautiful in the way dangerous things can be beautiful. Borrowed capital buys real assets. Operations are optimized. Costs are cut. Cash flow improves. Debt is serviced. Value is extracted. Capital is returned. The human cost sits downstream, too messy for the model, and too inconvenient for the investment committee. You did not invent the system. You run it well. That distinction helps you sleep at first, until one night you realize it may be the most dangerous sentence you know. Your limited partners are pension funds, university endowments, sovereign wealth pools. Millions of ordinary people are somewhere behind that capital, though you almost never picture them. You picture basis points. You picture fund performance. You picture the next close. The returns are good, and when returns are good, the questions get shorter. The one company you do not talk about stays in the corner of your mind. Quiet but never gone. You know what happened there. You know exactly what the debt did. Capital efficiency. 2 clean words that can hold layoffs. Closures. Pressure. Fear. And a boardroom where no one raises their voice. At this level, debt is not a cage you are trapped inside. It is the operating mechanism you use to move other people's cages around. You are fluent now. You know the senior tranche, the mezzanine layer, the covenants, the exit multiple. You are no longer afraid of debt. That should feel like victory. Instead, something in you gets harder. Then you move into distress. You run a $4, $8 billion credit fund, and your specialty is companies already under financial stress. You buy debt at 47 cents on the dollar from banks that want it gone. You wait through restructuring. You emerge as the senior creditor, sometimes even the new owner. A regional airline, a chemical manufacturer, a hospital network. You did not build these companies. You acquired them after they cracked, through the capital stack, because in this world, failure can be purchased. Your analysts track 800 credits on a watch list. When leverage climbs, when earnings miss, when liquidity gets thin, you are already moving. You are not surprised by distress. You are positioned for it. That is the entire strategy. You sit across from CEOs who spent 20 years building companies with their names, reputations, and families attached. Then you restructure them in Chapter 11. You do not see yourself as the villain in their story. You see yourself as the mechanism that decides what survives. You tell yourself you are making broken businesses viable again. Sometimes that is true. A failing company can become healthier after the old debt is cut. The contracts are rewritten, and the impossible promises are removed. But the question that follows you is not whether the math works. The question is who pays for the math to work. A CEO loses control. Employees lose certainty. Communities lose an anchor. You hold the senior claim and suddenly ownership matters less than position. The management fees arrive regardless. 2 in 20. Over 3 years, $190 million in management fees, whether every investment becomes a masterpiece or not. Your investors review performance each quarter. CalPERS sovereign funds, university endowments names so large they barely feel human anymore. The returns are strong, so the questions stay polite. No one looks too closely when the number is right. You learn that in finance, morality often stops at the edge of performance. Debt at this level is not a bill. It is a claim on the future of a business. You hold those claims, and that means you hold the right to decide what happens when the future arrives damaged. Control has almost nothing to do with who started the company, who loved it, or who worked there longest. Control belongs to whoever sits highest in the capital stack. You understood that years ago. What you understand now is worse people can lose control of their lives without ever knowing who took it. Then the room changes again. You are in a windowless conference room in Geneva. And this time, the future on the table does not belong to a company. It belongs to a country. $41 billion in external debt. You are the advisor renegotiating terms on behalf of the ministry. Across from you sit the IMF, European banks, and 3 hedge funds that hold 38% of the bond issuance. Nobody raises their voice. Nobody needs to. The numbers are already loud enough. Debt to GDP is 118%. The 10-year yield has spiked to 3%. The currency is down 31%. You know what comes next because you have read this document before in other rooms with other flags on the wall. Austerity, subsidy removal, privatization of state assets, cuts that look clean in a spreadsheet and brutal in a grocery line. You know the conditions are designed to restore debt sustainability. You also know they will land on people who never sat at this table. You negotiate the haircut anyway. That is why you were brought here. Creditors accept a 35% principal reduction. New bonds get issued. Maturities are extended. Coupons become linked to GDP. The IMF calls it a successful restructuring. Hedge funds call it a mark-to-market loss they may recover over a decade. The ministry calls it necessary. The press release uses the phrase debt sustainability. Outside this building, families will call it something else when prices rise. By evening, the room empties. The laptops close. The mineral water bottles are cleared away. A country's financial future has been rearranged in polite sentences and signature blocks. The population whose subsidies were removed will not read the press release. They will feel it at the bus stop, at the pharmacy, at the market. In the moment they realize yesterday's money buys less today. You do not personally raise their prices. You only help create the conditions that make it inevitable. At this level, debt is no longer just a financial instrument. It is a governance mechanism. Whoever structures sovereign debt can influence the policy choices of elected governments without appearing on a ballot. You know which foreign banks underwrote the bonds when the country was already fragile. You know what advisory fees were charged. You know which warnings were said out loud and which stayed off paper. Some knowledge belongs only in the room where it was learned. The creditor sets the conditions. The government executes them. The population lives inside the result. That sentence follows you onto the plane the next morning, though you do not write it down. The next file is already waiting. Different country, same structure. Different flag, same debt to GDP problem. Same creditor committee. Same careful language. Same ending where everyone says the system worked because default was avoided. But something in you has started asking what survival means when dignity is the collateral. Years later, you no longer negotiate one country at a time. You sit on the board of a private institution that coordinates liquidity policy across 12 central banks. 3 current finance ministers know your number. A former Fed governor returns your calls. A sovereign wealth fund chairman asks for your read before major issuance windows. You have not managed a portfolio in 9 years. You do not need to. The people who move portfolios call you first, and that is a different kind of power. You do not trade debt anymore. You shape the conditions under which debt is priced. That is the difference almost no one sees. When you advocate for a change in reserve requirements, banks adjust before ordinary people understand why credit feels tighter. When you privately signal that a country's issuance may face resistance, yields move before the public announcement. The mechanism is distributed, deniable, and functional. Nobody has to call it control for it to behave like control. Your office is on the 32nd floor of a quiet building in Zurich with no logo on the door. Your assistant screens every call. You take maybe 4 a week, and each one matters more than most people's entire year. You gave up the idea of a normal personal life long ago, though you rarely phrase it that honestly. A relationship ended because you were unreachable for 11 straight days. Your children know the outline of your work, not the details. You decided that was protection. You travel with security now. Sometimes you use a passport issued under another jurisdiction. Everyone around you treats this as routine, so eventually you do too. You are not powerful because you own the most capital. You are powerful because you understand how it moves. Who can access it? Under what conditions? And at what price? That knowledge is quieter than fame and heavier than wealth. It does not make you free in the way you once imagined. It makes you necessary. You no longer think about freedom very often. That word belongs to a younger version of you, the one checking a $47 bill, 200 balance before work, believing life would open up if the number went down. Now the word is leverage. You have it. People wait for your read. Institutions adjust around your signals. Countries, companies, banks, and borrowers feel pressure from decisions they will never trace back to your room. You have climbed all the levels and the view from the top is not clean. Somewhere downtown, a 22-year-old signs his first offer letter. He gets an employee ID, opens a checking account, and accepts the terms and conditions without reading them fully. He applies for a credit card to buy things he does not need because he wants to feel like he has arrived somewhere real. He thinks the game is simple: earn more, spend less, pay things off, become responsible. He is not wrong. He is just standing at the beginning of a map no one has shown him. The company he works for borrowed to acquire the building he sits in. The bank holding his paycheck is leveraged against its equity. The currency landing in his account is a sovereign obligation, backed by policy choices made in rooms he will never see. He spends it on lunch, rent, subscriptions, and the small comforts that help him feel less behind. When the credit card limit increase arrives, he feels approved. He does not know approval can be a business model. Above him, somewhere on a floor he will never visit, a phone call is made about liquidity conditions. It lasts 4 sentences. The market adjusts before he finishes eating. He will not feel it immediately. That is the trick. He feels it 6 months later when rent rises, when credit gets more expensive, when his employer delays hiring, when the car loan offer looks worse than expected. The system does not announce itself. It simply arrives later disguised as numbers. And now you understand the full shape of it. At the first level, debt felt like shame. At the next, it looked like adulthood. Then it became pressure. Then infrastructure. Then a weapon. Then a claim. Then a way to govern entire populations without calling it governance. Every level taught you a new language. Every new language made the old pain look smaller. But the truth never disappeared. Debt always asks the same question: who gets to decide your future before you do? You started with a balance in an inbox. You ended with an architecture. That is the distance most people never see. They feel the payment, the rate change, the rent increase, the lost job, the delayed dream, the impossible grocery bill. But they rarely see the structure above it. Debt does not need to be evil to be powerful. It only needs to be patient. It only needs contracts, habits, incentives, and people willing to call pressure by cleaner names. So when you look at a balance now, you do not just see what is owed. You see the hands behind it, the rooms above it, the systems beneath it, and the future being quietly negotiated before the borrower ever notices. The first danger was thinking debt was only money. The deeper danger is realizing it is behavior, time, policy, control, and sometimes identity. You can still use it. You can still escape parts of it. But you can never again pretend the number is just a number.